Before we begin, a disclaimer: this podcast is for informational and entertainment purposes only and should not be relied upon as the basis for any investment decision. Nothing you hear is an offer or solicitation to buy or sell any security. The securities discussed on this podcast may be owned by persons being interviewed. Before making any investment decision, please consult an investment advisor. All right, we'll redo it again.
Okay.
Let's give the listeners what they want. Big tech and AI.
Yeah, we're back. We're back with big tech, even though we tried really hard to avoid the topic, but it's really hard to switch it off, it just keeps coming back.
Yes. I'm looking through the Google Doc. So Meta here, the great AI Capex debate.
Yeah, so far, Google and Amazon had a good earnings reaction. Microsoft was down 2-3%. Meta is the one which is down 10-15%, something like that. And there's been a lot of debate around it, especially because Meta is probably guiding something like $150 to $120 billion capex. Obviously, Amazon or Google hasn't really explicitly mentioned. To be fair, Meta hasn't also explicitly mentioned 115, 120 billion, but we can kind of guesstimate. That's what they are suggesting, because they're mentioning that the increase in 2026 capex will be considerably larger than what they had in 2025, and they have already increased capex in 2025 by $30 billion compared to 2024. So if you assume $45-50 billion increase next year, we'll end up with $115-120 billion capex for Meta. And if Meta spends $120 billion capex, my guess is Google's probably going to spend $130 billion. Maybe 140, somewhere around that, because they are already spending $93 billion this year, and they mentioned 2026 is going to be significant percentage of increase. And if Google spends $130 billion, we can probably be almost certain that Amazon is also going to spend more than 140, because they also have a retail business to run, which is also kind of capital intensive. So lots of capex, the numbers get bigger.
These are such small numbers. Why are these guys being such pussies about CapEx? Crank it
Yeah,
up.
crank it up, billions. Where's the trillions? Billions is for such, an yesteryear number. We need to spend trillions, and then we'll be talking what big numbers look like. So, but we are joking, but who knows? Maybe give them 3-4 years, and with lots of debts, with lots of more cash flows, they'll get there. They'll get there. But
Yeah.
I'm curious, to hear your sort of reaction to this capex debate. I think the debate is kind of relevant for all of them, but it feels like, at least on Twitter, people are focusing too much on Meta. As one of our friends likes to mention, when the stock is below 200-day moving average, you find all those bear cases, right? So
Exactly.
So unlike other big tech companies, I think it's only Meta whose stock price is right now below 200-day moving average. So people are increasingly sort of almost feel fidgety about Meta stocks and how the capex debate is more centered around them. But I also, I think I did notice something among investors, which is unless a stock is outperforming on 1 month, 3 month, 6 month, 12-month basis, something's got to be wrong in that stock, in that
Yes.
company, and for the future of that company. Just before these earnings, people are talking all sorts of crazy nonsense about Amazon, right? How Andy Jassy probably needs to go, and they're not in the right track. They're losing the AI war to GCPs and Azures and Oracles of the world, right? And they're going to be left holding the bag, and all those talks and narratives have kind of subdued after just 10%, stock pop. So now the focus is back on Meta. But I'm curious, how you're kind of thinking about and processing, not just for Meta, but also, or whether you are differentiating these capex numbers between Meta and let's say the hyperscalers.
Yeah, I mean, so yeah, I guess I'll start with Meta first and then address the hyperscaler versus Meta CapEx question. I mean, my view on this is, so long as Meta is able to keep driving time spent on their apps, they can almost make revenue growth be whatever they want it to be by like playing around with ad load, right? And because the early stage ranking of those ads and the targeting gets sharper and sharper, they should be able to drive more relevance, which means they don't have to make the trade-offs between engagement and ad load to the same degree. And so, I mean, like advertisers, and I think Meta's been talking about this for a while, they're almost getting in their own way by just not handing everything over to Meta end to end. So I think on the most recent call, they said there's 60 billion of, call it 200 billion run rate ad revenue on Advantage Plus. And
Yeah.
so there's just massive progress there, but still, I guess, plenty of runway.
Yeah. So I really wanted to mention this quote because I do think this was perhaps one of the more interesting quotes during this earnings season that I have come across, especially in Meta's call. So this is the exact quote from Mark Zuckerberg. This quarter, we saw meaningful advances from unifying different models into simpler, more general models, which drive both better performance and efficiency. And now the annual run rate going through our completely end to end AI powered ad tools has passed $60 billion, as you were mentioning. And one way that I think our so this is Zuckerberg talking, and one way that I think about our company overall is that there are three giant transformers that run Facebook, Instagram, and ads recommendations. We have a very strong pipeline of lots of ways to improve these models by incorporating new AI advances and capabilities. And at the same time, we're also working on combining these three major AI systems into a single unified AI system that will effectively run our family of apps and business using increasing intelligence to improve the trillions of recommendations that we will make for people every day. I almost fell out of my chair when he said the end-to-end ad tools like Advantage Plus is like $60 billion revenue runner. Like I knew Advantage Plus is pretty big, and sometimes you forget looking at these companies, and obviously if Meta is generating like $200 billion revenue this year, and we know Advantage Plus is pretty big, so it's probably a pretty sizable number. But for them to kind of explicitly mention $60 billion, like that was kind of okay, almost like a jaw-dropping moment for me. And also then they mentioned about Reels being a $50 billion revenue business now, which was like I was closely following Reels obviously over the last 3 years, and it was like a $1 billion revenue business in 2Q 2022, like just the other day, like 3 years ago. Now it's $50 billion, and those two numbers, like I felt like that kind of contextualized in my mind how fast paced and how quickly things can change when you really find the correct, the depth of the product market fit, when you really find the sweet spot, the scale, the speed can really be surprising.
Yeah, and I mean, related to what you just read there, I think an important thing to recognize is that when they talk about like a 3% improvement in conversion, that's not just like a one-time lift, right? There's going to
Right.
be an ongoing series of improvements in the
Yes.
algorithms and the
Yes.
models that the current CapEx can support. So you need to think of it like 3% on top of 3% on top of 3%, that kind of thing, as the models and the methodologies get better. So, for example, in the latest earnings call, they said they're piloting a new, ads ranking model that can use
Mm-hmm.
more compute and data than previous models. And that drives like a 2% lift in conversions on Instagram, right? And then
Yep.
the other thing you're getting is obviously an acceleration in impression growth through some
Mm-hmm.
combination of more time spent and ad load if they want to press that lever. So, like for me, the long and short of it is I'm not that worried that this tick up in expense growth and capex is really that big of a deal. I do think we need to worry about whether the cohort of CapEx 3 or 4 years down the line produces the same incremental returns. I think they probably will, but I just don't feel like we need to worry that the returns on the CapEx going into the ground in the next few years is, at risk of value destruction. So, they're spending 70 billion CapEx, right?
Uh-huh.
And then you've got to ask yourself, what percent of that CapEx pertains to the AI related stuff like Andromeda and Lattice? And then, do you get that revenue lift over 2 years or 3 years on top of that? I don't know the answers, but that's kind of the general framework, I think. And I think if you just kind of play around with the numbers, it doesn't really require aggressive assumptions to make the math work. And, you know, again, like to be absolutely clear, that doesn't vindicate all the CapEx spend
Yeah.
by Meta for the rest of time. It may be that the next $100 billion slug and the model improvements on top of that only generates like a 1% lift, and then the next 200 billion only generates like a 0.2% lift. But the point is, like, at the moment, there doesn't seem to be much evidence that Meta is building a bridge to nowhere here. And yeah, and I just think, uh, just
I
eyeballing
think
it here.
one thing that I really want to note here is I think it matters a great deal why the return isn't there, right? So, for example, if Meta spends $100 billion and there isn't, let's say, a noticeable lift in conversion
Mhm.
or like in time engagement or time spent on their platforms, is it because they did a poor job? In kind of utilizing the capex, like they didn't have the right talent, they didn't do things properly, right? In that
Yeah.
case, I can see a scenario where uh, Zuckerberg is saying, well, we misspent this $100 billion, like because
Yep.
we didn't pursue it correctly. But there is a way I can see that if we do things differently, then we would have gotten that extra 200 basis points, 300 basis points, 500 basis points, let's say, lift in conversion or engagement or time spent, right? And in that case, I can see a scenario where he is doubling down. But if the reason is, oh, we actually did things the way it's supposed to, but we didn't see any improvement, any lift, then he wouldn't need to do it. Like he wouldn't need to double down, right?
Yeah.
So I think the why matters.
Yeah. Yeah. Like this isn't like a late 90s, lay a bunch of dark fiber
Yeah,
capex and just see what happens, right? And roll the dice. It's not that sort of thing. And I mean, just eyeballing it, if I look at the numbers here, I mean, since 2019, Meta's invested capital is up by 130 billion and their
yeah,
operating profits are up by almost 60 billion. So they've earned, let's say mid 40s incremental on a pre-tax basis, and that
yeah,
includes growing losses from Reality Labs.
yeah,
So, I don't know. I think it's a bit premature to um be a bit be bearish on Meta's CapEx spend based on what we know today.
yeah.
Um, yeah, and then, I think there's this other, question that's been floating around about, is their CapEx sort of safer than the CapEx that
Hyperscalers.
AWS, the
Yeah,
hyperscalers
yeah,
are putting down? And, my thoughts on this is I think there's a few different ways to frame this question.
mm,
The first way to answer this question is in terms of the risk-adjusted payoffs for the first best use case, the second best use case, the third, et cetera. So for Meta, the highest probability payoff today is clearly, the core ads business. And then the next best use case for the GPUs, as they've spelled it out, might be, let's say, business messaging, and then Meta AI, and then below that, I don't know. You can work your way down the ladder.
yeah,
And I think like the thing to recognize for Meta is that, at least for me, and you may have a different opinion, is that there seems to be like a big drop off as far as payoff uncertainty goes as you move down from ads um, to the more speculative stuff like Meta AI. So like Meta AI, the chat app, it's a lot more speculative. The core ads is, I guess, what I'm saying. Like I
uh,
don't think, whereas I don't think the drop off is nearly as pronounced for Google. So I mean, when
uh,
we think about, let's say, AI overviews, YouTube, all the training and pre-training and inference workloads on GCP, it's not even obvious to me how you rank those in terms of payoff probabilities because
yeah,
they all seem pretty good, right?
yeah.
And so in
How
that
times
sense,
change, we are all worried about Google.
exactly. And so the CapEx does seem safer in that sense, right? Like, in
Yeah,
other words, Google arguably has more equally high payoff options for that
yeah,
CapEx than Meta has.
mm,
However, the core ads use case for Meta might be so damn creative and compelling for reasons that I've sort of laid out earlier that it doesn't matter what the third or fourth highest option for it is. Now, having said all that, if the question is, does this range of enterprise AI use cases that the hyperscalers have access to, does it generate a lower risk or higher increment, a lower risk, higher incremental ROIC than the social media use case that Meta has access to, 3 years down the line, 5 years down the line? And as with so many AI related things, I don't have a clue, right? And I don't think really anybody can have a firm answer to that.
Yeah.
However, um, you know, and I don't want to use the word addiction here because I know that's a loaded term, but let's just say that there are some products that take effort to use, and then there are some products that take effort not to use. And I think and I think social
uh,
media
I know where it's going.
so social media falls in that latter category, okay?
Right,
And I
right.
do think that, like, products and services, just that sort of nip at our basis, most primitive instincts, have infinite degrees of improvement. So
Mm,
so, like,
yeah,
for me, like, Meta, that they don't need to sell anything. They just can
yeah.
tune the gears in the background, and then zombie users like me just passively increase the scroll activity without even knowing they're doing it. So I don't know. I feel like that there are just, these engagement tricks that Meta can play here, to continually suck people in a way that might be a bit harder to do on the enterprise side. And then, like, I think the second, way to think about this question
So
is, are yeah.
yeah, I mean, I thought that was actually kind of insightful, the way you kind of framed it, that there are products that you need the effort to use, and I feel like ChatGPT is probably more on the farmer, and then social media, like Instagram or TikTok, it requires sort of effort, or even Netflix, right, or YouTube. It requires a bit of an effort to not to spend time there, to decide consciously that I shouldn't waste time, let's say, on watching like a TV show or like scrolling reels or TikTok. And I think the other point about the way you kind of ranked Google and Meta and like different nature of payoffs beyond the core, and the way you kind of explained that it's really hard to actually even rank different applications within Google and like which one ranks higher than the other, given how sort of embedded AI is in their products. I think those were really insightful points. I also want to add something for, let's say, hyperscaler and Meta and all that. One thing that I feel is for Meta specifically, if you think about overinvestment or underinvestment in AI, and how this capex like debate will kind of evolve, uh, because Meta is almost entirely just serving the internal needs and building the internal compute.
Mhm.
I think they have lot clearer. So it may take a little longer to ramp up. In like people are saying that, oh, for hyperscalers, you just uh, build capacity, and once the moment the capacity comes online, you start making money from day one, right? And that there's definitely an appeal for that, as you are kind of monetizing your capex. Versus, let's say, Meta, as you were saying, beyond the core ads, which has like more clearer payoff. After that is more hazy, more sort of speculative. But I do think they have a lot more visibility. If it's not working, it's not going to take, more than a quarter or a couple of quarters for them to figure out, hey, it's actually not quite working. Something's wrong.
Right.
It's either our approach that's wrong, or or maybe then more money is not the approach here, right? My understanding is Meta will come to this conclusion faster than hyperscalers, especially for someone like Azure and AWS. Uh, Google is a bit of a special case, I would say. They have massive internal demand, and they also have massive PP third party customers, right, through Google Cloud. So
Yeah.
uh, so for AWS and Azure, they may be there may be a degree of separation, right? At one hand, you can say positive that uh, they have a very diverse set of customers, right? And they are going to do all sorts of experiments. Some will work, some will not work. And the ones that not work, they're not going to add capacity. They will just do something else. And the ones that work, people they will double down and they will use more compute. They will use more services, and AWS and Azure will be fine, right?
Yeah.
That's one way to look at it. The other way to look at it is basically, if, for example, AWS ends up overbuilding, I think it will take longer for that message to come through to them because their customers are trying to build things. They're trying to maybe
Yeah. So this is like the difference between, supporting third party versus first party products, right? With the first party, you just have a lot more control and real time visibility into what's going
right.
on. And then, yeah. And then like the other side of the argument is, you could argue, well, there's a more diversified base of
Yeah.
demand
Yep.
if you're supporting third party. But
Yeah.
to take the other side of that argument, if there turns if there turns out to be like extreme power laws higher up the stack,
Yeah.
then you might imagine like a single large customer like Anthropic or OpenAI making up a huge portion of that revenue. And then you start to question how diversified that really is. I don't know. There's just so many
I mean, yeah,
so many
there's
angles.
different, so many layers for sure. Like even
Yeah.
I would say as of today, I think I have heard Dylan Paddle mentioning that 33% of GPU is basically going to OpenAI and Anthropic
Mm.
so far. So to your point, maybe it's not that diversified, and and if it doesn't get diversified over time, then yes, like that benefit that was supposed to flow through to AWS and Azure may not materialize, right? And they
Yeah.
may be a degree or two separation away from understanding where exactly we are in the cycle, right? Versus let's say someone like Meta. Uh, so, so yeah, but also at the same time, I mean, theoretically, I understand the point that it is absolutely possible to overinvest. But what I think where I am sort of like, let's say disagreeing a bit from some people is basically it's actually harder to know uh, given what has happened in the let's say last 5 6 years. Like I mentioned how Google and Meta, for example, they have
Mhm.
deployed 200 to 300 billion dollars of invested capital, incremental invested capital in the last 5 6 years. And I kind of ran this hypothetical in my mind, and I also mentioned about this. Like imagine a genie came to you, and and I'm just going to give you this data point, right? That
Mhm.
Meta, they're going to spend another $150 billion incremental invested capital in the next 6 years. And Google is going to spend like another $200 billion incremental invested capital. Imagine in 2019, Pat Dorsey was going to invest like the best, and he couldn't figure out how Meta is investing $18 billion in Capex. And if
Yeah.
you if you let Pat Dorsey know, hey buddy, this company is actually going to invest $150 billion more, right, in the next
Yeah.
6 years. He's going to freak out. He would be freaking out, and he would probably sell all his shares, and I'd be freaking out too, to be honest, right? And what happened? What happened is for Google and Meta, ROIC has not degraded, right?
Yeah.
So when I look at that, I'm in my mind, I'm kind of soul searching a bit, right? I'm like, okay, theoretically, I understand, like intellectually, I understand that it is possible to overinvest, right? It's not like you can just throw $1 trillion and you'll still get 40%, 30% ROIC. Intellectually, I know that's not right, right? Uh,
Mhm.
but at the same time, I'm like, okay, I would be absolutely wrong if someone told me 6 years ago that this company is going to, deploying 150, 200 billion into capital, and I would be so confident that ROIC would degrade if you throw such large amount of capital, and it did not, right? Uh, so I'm kind of, I like, this is what I mentioned. Like, and I was talking to one of my like, readers, and this is exactly what I mentioned. Like, if you are not soul searching a bit, when you're kind of wrapping your head around like where things are going, how do you feel about this capex? If you're like so confident, like, oh, we are just going to continue to generate 30-40% ROIC, I don't think I quite really share your confidence. At the same time, if you're like so pounding the table, we are in a bubble. We are in a bubble. Like I just don't share your confidence either, right? So it's kind of this weird sort of limbo, right? And we will have to kind of navigate through it. Uh, yeah, like I also did the exercise. Okay, like even if Meta on overinvests, like actually, like even if Meta, for example, overinvests a lot, like for the next year or so or a couple of years, the intrinsic value deterioration is like 20%, 15 to 20%,
Mhm.
right? And I'm like, okay, if I'm Mark Zuckerberg, do I really care? Do I lose my sleep over 15 to 20% intrinsic value deterioration? Not really.
Yeah.
Like, the opposite side is like much more scary. Like, you like this is sometimes I tweeted about this, like how Reels has become like $1 billion business to $50 billion business, and someone like replied, "I wish you didn't invest in AI and reality labs." Like, oh, so how do you think Reels is happening without AI? How would it happen, right? So yeah, like it's just hard to know exactly where that payoff, like steeply falls off the curve. Uh,
Yeah. Yeah. And I mean, returns are going to degrade eventually, with a
Eventually,
large enough capital base, right? But even if they degrade, even if the incremental returns go from, wherever they are now in the 40s to like, pre-tax to, the 20s or something, that could still be value accretive, especially if
yeah.
you're talking about like 400, 500 billion of capex, right?
So,
If those are the
so David,
numbers.
this is what I'm sometimes gets confused about. Like sometimes people would say, "Oh, these companies are not generating free cash flow." I'm like, dude, if Meta can maintain their ROIC at 30%, I want free cash flow to be zero. No, I think a lot of people actually get tangled up with this thing. Like people know free cash flow is important. That part is kind of widely well understood, but I think the mechanics is can only can often get lost. Like for example, Walmart had like negative free cash flow for I think like years, even until like late 80s or something like, or yeah, late 80s I think. Home Depot similar. Like yes, you are supposed to run negative free cash flow or like no almost very low free cash flow if you can generate incremental high ROIC on the capital you're deploying, right? That's totally normal. And if you're a bear, if you're an AI bear, I think where you should probably focus more on is you can say, oh, the earnings is inflated because of the depreciation schedule and all that. That's a different debate. Now that would be valid debate. Like you can say, yeah, you can say that earnings are fine even if free cash flow is not, but earnings are inflated because of the depreciation
Yeah.
extension of useful life and all. But yeah, that also like, I think I kind of discussed this before. It's not super easy to establish that. When you look at
Yeah.
like how the depreciation schedule has evolved, sometimes I actually feel like when I looked at the historical trends of how useful life have evolved, I almost felt like these hyperscaler companies, especially like Amazon, purposefully like lowered their useful life to make sure their margins are not too high, like they're not reporting like like 50%, 60% operating margin. Like that would be almost like sort of like almost a bit of a criminal,
Yeah.
like, and like an invitation for others to come join as hyperscaler. Like if you think about it, like uh, uh, the way so they used to report like 25% operating margin, 30% was like a huge cheer. Oh, AWS reported 30% operating margin. Now they report 30% margin. People would be like, oh my god, like look at this business, like they're not generating any return. Like it's just
Yeah.
commodity business, just 30% operating margin business, commodity business, right? Uh, so yeah, like I feel like in the way kind of the depreciations. I was worried about depreciation schedule in the beginning of this year, but as I spend more time, I realized actually what is more likely is that they underreported earnings. Big tech has actually underreported earnings, the hyperscalers, in like 2015 to 2019 sort of period when the depreciation schedule was like much shorter compared to what they're
Mhm.
reporting now. That to me is actually more likely than the other way around. So yeah.
Yeah. Yeah. I mean, look, this is why this is just so, there's just so much debate over this because yeah, there's this high level question of what the incremental returns are, but to even answer that, you need to, look at the denominator and numerator sort of separately, and there's a whole separate debate on each of those topics. And with the
Yes.
numerator, you drill down to that, it's like, okay, what's the useful life of the of the capex they're putting into the ground? And there's a huge debate over like that
Yes.
fine point.
Yes.
And so yeah, and I thought it was interesting on that topic. Microsoft they had made this point that the lifespan of their GPUs. So they distinguish between, the CapEx that goes into the data center and the CapEx that goes into GPUs and
Uh-huh.
CPUs. And so
Uh-huh.
the stuff that goes into GPUs and CPUs, that's a lot shorter, obviously. And what they said is they tried to kind of maturity match that against the the average length of the contracts that they have. So I think they said, the weighted average life of the remaining performance obligations is something like 2 years, around 2 years. And they said
Mm.
that they tried to match the life of the GPUs and CPUs to around that, which would imply like a pretty short life for the GPUs and CPUs. But it's an active question because I know you had made the point earlier that, well, it's there are other use cases besides training, right?
Yeah.
You
Yeah.
can kind of use GPUs to for inference use cases, and you can kind of go down the ladder here. And
Yeah.
I think maybe Gavin was making this point. I think it was I don't even know anymore. But that like, even if you look back to like um the GPUs that NVIDIA was rolling out, 4 or 5 years ago,
Yeah.
you're still
Yeah.
earning like $1 per hour
Yeah.
on those, right?
Yeah. Yeah.
And so that would
Yeah, I think it's
suggest that.
some guy from Google actually mentioned in a recent A16Z podcast that
Mhm.
TPUs that were kind of launched 7 years ago, they're still being utilized 100% of the time, right? So
Okay.
yes,
Yeah.
even today they have like 100% utilization. So I'm pretty sure they did not assume useful life for those TPUs to be 7 years,
Right. Right.
right? But it's
Yeah.
still going on.
Exactly. Yeah. And then there's yeah, so it's confusing. I don't know. I mean, I'm probably not as close to it as you are, but like I just find myself saying I don't know a lot. I think about
I
this.
think if you keep saying I don't know, yeah, I'll be more in agreement because no matter how close you get, again, like I do want to make a distinction here. What I am saying is I'm looking at the past and I can see all the ways I would be wrong, right? All the ways I would
Mhm.
be wrong if I knew certain information, certain data points, and I could see how I would come to the wrong conclusion, right? The point I was making about invested capital increase and ROIC and depreciation schedule, useful life, and all that. But also, I'm not ruling out the possibility that the future may still be different compared to what we have just experienced, like in the last 5, 6 years. For example, we're talking about depreciation schedule, but Nvidia has been accelerating their release schedule, right? And there's
Yeah.
this power bottleneck, right? So
Right, exactly, that's the other thing.
so
Yeah.
so there's a lot of moving pieces. So maybe the reason we had all this depreciation schedule turned out to be longer than it was reported to be, because we were not dealing with that power bottleneck. We're not dealing with like
Yeah.
this accelerated release schedule by Nvidia, right?
Right.
Now, when all those things change, how will the aggregated outcome will change? Like that's not super easy to figure out, right?
Yeah.
And I
Yeah.
feel like it's probably difficult for everyone to figure out. Like market is trying, obviously market. There's a bit of a wisdom of crowd element to it, but I don't think the outcome is uh, clear yet, even to most sophisticated market investors,
Mhm.
sophisticated investors out there. So we are all still trying to, and also again, I do think geopolitics is also a super critical element here. Like for example, just this weekend, there's been talk about China and U.S. coming to an agreement, coming to sort of a deal, right? Then just talk about getting a power deal or not power deal, like some sort of peace deal in Middle East, right? And Middle
Mhm.
East can have abundance of power, right? And I can totally see a future where pretty colossus sort of training clusters are actually being run in somewhere in Middle East. So yeah, there's just so many different ways it can go, and I feel like as an analyst, as an investor, I'm just trying to keep all these different scenarios in my head and trying to stay still, trying to kind of uh, focus, but at the same time, I'm kind of tilting one way or the other every few days and every few weeks, depending on what the news flow is kind of telling me. Like a couple of weeks ago, if we were talking, I would be a lot more worried about China, US.
Yeah.
That's why I actually bought some puts, right? Because I was worried, like, hey, my conclusion was the differences between US and China are just so great these days that they cannot even pretend to have a deal, right? Fast forward to 2 weeks, yeah, it almost feels, Pete Hexen is tweeting about, yeah, like, very positively about China, right? So who knows down
Yeah.
the line?
Yeah, definitely. Okay, well, switching gears here, let me ask you, how do you compete against Amazon retail?
I actually think a lot of physical retailers got lulled into thinking uh, the worst threat from Amazon is over, like behind them. Like, they kind of, uh, 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 like, back in 2000s and 2010s, this used to be a lot more front and center. Like, for
Mhm,
example, when Amazon bought Whole Foods, the whole sector was kind of freaked out. Even the Costco's, Walmart's of the world, the stock dropped, pretty rapidly. And now I think we're in a moment. I know most physical retailers, I feel like, they are kind of lulled into thinking, yeah, the worst is over. Like, people realize Amazon cannot really outcompete all of retail, and I don't think that conclusion is quite incorrect. But also, I do think there are a lot. Like, maybe the Walmart will be fine. Like, Walmart has really woken up, and they got religion in e-commerce. Say 20% of their sales is in e-commerce now, and I think they're delivering 95% of their U.S. households in like 3 hours or less, and they're actually faster than Amazon when it comes to like same day delivery. They're only limited by the inventory they keep in their stores. So that's the limitations that they have. But retail is so big, right? There's so
mhm.
many like physical retailers out there, so many grocery shops out there, right? And it's like when I imagine the world 5 years, 10 years, 15 years down the line. I just find it hard to believe that all these physical retailers will find the relevance. Like, in a lot of these physical stores are basically built in the assumption like 2 to 4% of same store sales growth. Amazon doesn't need to like kill them overnight. I think demographic can also play a role. Like, Gen Zs, the millennials, as they age over time, I'm pretty sure uh, uh, our wallet share, Amazon's wallet share amongst millennials and Gen Zs compared to say boomers, they have greater purchasing power over time, and Amazon has higher wallet share of these generations. And on the other hand, every single year Amazon is going to be faster. The shipping speed is only
Yeah,
going one way, right?
yeah, and so, yeah, for me, I think when it comes to logistics, it's really hard for me to think of, how you compete against Amazon, but I think maybe at the front end, there might be an opening here. So, I mean, well,
Right?
first of all,
Yeah.
I'll say this, like,
Yeah.
it's hard for me to imagine, at least in the next 5 to 10 years, that humans will be completely cut out of the shopping loop, but I can imagine maybe other ways that, AI can, insinuate itself into the shopping experience in a way that isn't great for Amazon. So, for instance, Amazon, for now, it's really about like product search rather than discovery. And
Yeah.
I mean, you might imagine like Instagram getting so good at targeting and conversion and, creating the right ad copy on behalf of advertisers that discovery share of consumer discretionary spend just increases. And maybe that takes some incremental spend away from Amazon. So there's that one kind of oblique angle of attack. I think like more generally, like you can imagine like AI agents opening up the retail landscape in the sense that, they reduce the friction of finding the optimal price quality trade-off. Like I default to Amazon for most of the things that I buy. I don't even bother to check if there's a cheaper or better option out there because it's too much of a hassle.
Yeah.
But,
Yeah.
like maybe an agent can do this trivially and bring it to your attention. So like so here's what comes to mind. Like if you ask most people like what gives um, Amazon a right to win in ads, I think most people will say first party data. But I think you need to go like even a layer deeper than that and ask, well, what gives Amazon the right to collect the first party data in the first place? And I
Mm-hmm.
think a big part of that answer is going to be its logistics infrastructure.
Yep. Yep.
Like I think
Yep.
of all the tremendous assets that Amazon has as at its disposal, its logistics network may be the most dominant and toughest to replicate. And the reason I bring this up is because they I was reading this article, maybe it was fast retailing, I'm not sure, but they just mentioned that, Amazon was gonna be opening up the, multi-channel fulfillment to competitors like Walmart and Shopify and,
Hmm.
Shein. So
Yeah,
so
yeah.
multi-channel, fulfillment, that's been around forever. It's just, Amazon, extending its captive logistics assets to other merchants. And so, why give competitors access to this unique resource? And I think possibly, one reason might just be to like prepare for a world where like AI commerce sort of spreads the retail shopping experience beyond the Amazon walled garden. Maybe you can imagine a world where um, agentic commerce meaningfully expands the retail pie, but maybe Amazon has a smaller share of that pie at the front end of the shopping experience. So to be clear, they're still capturing more front end shopping 5 or 10 years from now than they do
Mm,
today, just a
mm.
smaller share of a larger pie. And if that's the case, then where you want to capture the economics is not at the front end, but the back end, right? So like Amazon can essentially be um, like a toll collector, right? For like a much bigger retail universe by operating the logistics layer behind all of that.
So it's hard.
Um,
I think you point out a different sort of like angle of competition, which is the front end. Right now, it's like I think Amazon and Google kind of 50-50 in terms of like product search,
Mhm.
right? Obviously, OpenAI is coming to the scene. Meta is more of a discovery, like you don't really search product there.
Yeah.
But I can definitely imagine, a scenario where people would search product on like OpenAI, right, or ChatGPT. And if more and more that happens, I can see how Amazon and Google both can lose share to such agentic experience. But also, I think Andy Jassy mentioned in the call, uh, it's just so early yet. Like, for example, we don't know, like, speed is something I definitely care about. Selection is important, but speed is probably at times more important to me. And the reason I think, for example, Metashop or like, even agentic commerce personally doesn't quite appeal to me is because of that sort of like, lack of speed, right?
Yeah.
Like, it's going to take longer and longer. And companies like Amazon and even Instacart, for example, have been really changing the expectation game, right? Even for example, someone like Instacart, actually, even for Amazon, is hard to compete against on or even Walmart. It's really hard for Amazon to compete against Walmart's sort of like grocery delivery experience because Walmart delivers it like in less than an hour for like 30% of the cases, right?
Mhm.
5 years down the line, 10 years down the line, Walmart is probably going to deliver everyone in like less than an hour, right? So it's actually hard for even Amazon to effectively respond to that. But I do think there are ways Amazon can still respond to that. For example, uh, uh, the pickup time for shoppers. Uh, Generally speaking, that's the highest. That's the longest time spent in the entire process for the shoppers. Uh,
Mhm.
but you can really accelerate it if you have like a specialized warehouse of like
Yeah.
perishables, and it's just the robots which are picking things up, right? Then you can actually 4 to 5x the speed compared to a human shopper, right? In that
Yeah.
case, I can see how for example, if you are a Prime member, like you have already paid for Prime subscription, then you may feel like, okay, what's the difference between 30 minutes and 45 minutes, right? Do I
Mhm.
really need to pay an extra subscription for Walmart or Instacart versus, let's say, the fact that I already have a Prime membership? Yeah, Amazon probably can't, beat Instacart or Walmart in speed ever in terms of grocery delivery,
Mhm.
but they will take like 15-20 minutes longer, which is like probably
Yeah.
totally fine for most people for most things, right? uh so
Yeah.
that's why I feel like, again, like the point I'm making is like, when I look around for like 5-10 years down the line, right? It's not going to happen next year or the year after. 5-10-15 years down the line, you know it just gets harder and harder for anyone to compete against Amazon, unless I think there are probably one way.
Or
uh,
maybe like drones become the great leveler
Exactly,
as a
exactly.
last
That
mile or something
maybe
like
there
that.
is a level. Usually, the way world works, you know, I don't want to assume that, oh, we are at the end of time, right? And maybe it's going to be Google who's going to kind of arm the rebels here, right? Like
Yeah,
say
yeah,
there's physical retailers, they can't really like build a warehouse full of robots, right? Uh, but maybe Google can build an infrastructure, right?
mhm,
Which would let you kind of use their drones. Or Walmart obviously can do that, but there are ways you can probably compete, but it's just not super easy to kind of outline it as of today.
yeah, yeah, yep. Good point. Um, Good. So let's see. We have maybe 5 minutes. Okay, so I think I have to just quickly answer this question. Well, as quickly as I can answer this question that's been sitting here for a few months here about Align.
Okay.
So we're taking a radical left turn here. So all right. So moving away from big tech. So I did get this question from a subscriber here. Okay, and it goes like this. Okay, consistent industry feedback across a range of channel checks. Former Align marketing directors, Align sales reps, Angel employees, ortho customers was that ASPs need to decline further. So we're talking about Align technology, by the way, that makes the
Mhm.
Invisalign braces here. So I spoke to a sales rep from Angel, which made me think that their impact on industry pricing is still at an early stage, particularly as they gain scale and broaden their offering to general dentists. It seems like Align will need to keep meeting their customers with volume discounts and allowing down trading to lower ASP packages. Generally, medical devices tend to be a deflationary category too, so the base rates aren't great as clear aligners as a category continues to mature. To compound matters, I believe orthos are also feeling some pressure to maintain their fees. Wondering how you think about the implications of this from the revenue growth standpoint and a margin standpoint. Currently, Align has an unparalleled reputation at universities, research organizations, and in the consumer realm, but are currently spending 40% of sales on SG&A. I wonder if pressure to maintain earnings in the face of declining ASPs will lead to their share of voice declining while Align Angel trends the other direction. Okay, so it's been a while since I wrote up Align, so I had to take a few notes here. So all right, so I go back and forth on this question, and I haven't yet figured it out.
Mm.
And I was actually hoping that my research would lead me to one conclusion or the other, but it didn't. So, in the
Didn't.
absence of a clear answer, let me just sort of lay out the case for and against Align being able
Mm.
to retain pricing, and everyone can just make their own determinations on this.
Mhm.
Um, so like so before we get into it, I think the first thing to recognize about Align's reported ASP is that it's not purely a function of price. So there's also product mix and FX moves that can confound year-over-year comparisons. Having said that, management has commented on earnings calls that part of the pressure in ASP over the last year or so has come from discounting. So that's kind of the first data point in favor of pricing concerns is that, well, it's already happening, right? And it's no coincidence that this pressure is happening at the same time that Angel Align. So Angel Align is the Chinese competitor to Align, but they recently broke into the North American market. Um, and so Angel is it's like a low cost alternative
They
to
don't have any tariff imposed on them?
um I think they have local
Oh,
they're
I
building
see.
out
I
local
see, I see, I see.
manufacturing capacity.
Okay.
Yeah. Now, so the pushback to the argument that Align will be forced to yield on pricing that I typically hear is that
Mhm.
aligners, unlike all other orthodontic products, are consumer brands. So consumers know the Invisalign clear aligner brand by name in a way that they don't know like who made their braces or who made their tooth implants, right?
I see.
And so Invisalign is really the only widely recognized aligner brand in the market. So when a patient goes to their orthodontist, they don't ask for clear aligners, they ask for Invisalign by name.
Mm.
Okay. So the argument is that, this consumer preference should translate into some pricing power. So that's maybe one argument. The second argument in favor of pricing power is that the most complex for the most complex cases, Invisalign is widely considered just better. You almost never hear somebody say some other competing brand is better than Invisalign
Mm.
At best, you say they're maybe equal to Invisalign.
Like, what's the price difference between, let's say, Angel and Invisalign?
So Angel will sell to the orthodontist for about, let's say, 850 a case.
Mm-hmm.
For Invisalign, if you're a high volume orthodontist, you might pay about 1,200 a case. If you're a low volume
Okay.
orthodontist, you'll pay closer to 2,000 a case. So
Oh, wow.
it's a
Okay.
pretty big price difference, right?
Yeah.
And so okay, and so the third argument is that almost since the very beginning, Align has faced competition from low-cost competitors. Because I mean, I remember looking at Align as a possible short candidate back in 2012, 2013 at the hedge fund I
Mm.
was working for at the time.
Mm-hmm.
And so this pricing bear thesis has been alive and well for many
For
years, okay?
10 plus years. Yeah.
Yeah. And there's a growing number of cheap brands out there for orthodontists to buy. This was always the argument. There's a lot of competitors, cheaper competitors. Some of Align's key patents are rolling off. Align's pricing is going to get crushed, and so will their margins. And this thesis, it just never played
Mm.
out. Okay, and so and so like yeah, even today there are a lot of cheap aligner brands out there in the U.S. There always have been, but none of
Yeah.
them in the U.S. are profitable as far as I know. They might be a few maybe break even at this point, but none generate consistently healthy margins. And Smile Direct Club, which imploded, they tried to offer this very deeply discounted aligner treatments, and they were forced to jack up prices over the years, and they still lost a ton of money. Okay, and so I think one thing to maybe remember here is that this is a manufacturing business at the end of the day. It's subject to scale economies. And Align has like three-quarters of volumes in the US, so they just have more scale than anyone else. And by extension, that should mean some advantage here as far as like unit costs go, right?
Yeah.
And then like the other thing you have to think about is like what kind of doctor is buying clear aligners because the prices will vary a lot. So as I was saying, like an orthodontist at the uh, at the very lowest volume tier will pay close to 2,000. At the
Mm-hmm.
highest volume tiers, they might pay closer to 1,000. And so there's a huge difference between 1,000 and 2,000, right? And
Yep.
so, you know, $1,100, that's still a premium to Angel's $850. But one other reason why high volume orthodontists tend to stay loyal to Invisalign is because Align has a reputation for being very reliable in terms of support and delivering the correct number of liners that they're supposed to on time because their manufacturing is so well tuned. And there's also some lock-in with the ClinCheck software, the treatment planning software that they use. So it's like a pain. It's a pain for the staff to retrain on a new untested platform.
Mm.
And so and there's something of an 80-20 rule with respect to Align where uh, maybe 20% of the highest volume orthodontists account for 80% of Align's volume. And so, and I don't really see Angel Align sneaking in there and stealing away the high volume orthodontists. And
Do we
that's not
know? Do we know what's the gross margins for Angels?
not in the US, no. But in China, they're very profitable. Their EBITDA margins in China are um are comparable to Align. So
Oh, I see.
they're discount competitor, but they're still generating healthy margins in
Mm.
China. And so yeah, I mean, look, it's tough. One of the toughest parts about investing, as we've talked about in the past, is teasing out the cyclical effects from the
Mm.
secular. And when it comes to like these clear aligners, one thing to recognize is that foot traffic at orthodontists, it's been in like a 3-year depression, right? Like, um,
Why is
it,
that?
it, I I don't know honestly. I mean, like back in 2021, people expected like 20 to 30% volume growth for a line as far as you could see. And now that's ratcheted down to like 5 to 15%. So it's really come down. And when growth slows, there just isn't as much, pie to go around. And so you're going to see more price competition. So it could just be that the price competition we're seeing today is just a function of the fact that growth is slower. And when traffic recovers, prices will firm up. Okay.
Mm.
Now let me take the other side
Other
of the
side.
argument.
Okay.
Okay.
Okay. Go for it.
So this brand argument where like Align has this great consumer brand, I think I found that compelling some years ago, but I've cooled on it for a few reasons.
Mm-hmm.
Um, and so let me just read this section from my write up here. Okay, so being synonymous with a category in the same way Google is with search can be a sign of brand strength, but it could also be a symptom of commodification when the advantages of one product over another aren't obvious to the end users, and when messaging is filtered through an intermediary that is incentivized to position all brands as indistinguishable. How many consumers have ready mental access to the words clear aligner? Patients ask for Invisalign when they really mean clear aligners, in the same way people ask for Kleenex when they really mean tissue paper. The branded term just rolls off the tongue easier than a generic one, right? So the point is,
Mm,
just because your brand is well recognized doesn't mean you have pricing power. Like consumers may just be citing your brand because they don't know what else to call the thing they really want,
mm,
right?
mm-hmm. Yep.
And the other thing, the other reason why brand is less important here than it may seem is that orthodontists by and large, control what what the patient chooses. So if the patient comes in and says, "Hey, I'd really like Invisalign," and the orthodontist says, "Do you mean Invisalign or do you just mean clear aligners? Because we have Ortho
Mm.
Clears and these other brands here that I can
And
offer
they're
you for
all pretty
20%
good.
lower, and they're all pretty good, right?"
Yeah.
The
Yeah.
vast majority of the time, the patient will just go with what the orthodontists
Right.
recommend.
Yeah.
So, okay, so now, now, as for this claim, the second claim that Invisalign can handle more complex cases better than other brands, well, yes, that might be true today, but the competing brands are getting better all the time. So if you were to look
Mm.
at the alternatives out there 10 or 15 years ago, like ClearCorrect and all the rest, those could only handle very simple cases. But today, the universe of cases that they can handle is much bigger. So, maybe they can't handle 90% of the cases, 90% plus of malocclusion cases the way Invisalign can, but they may be able to handle like 60 or 70%, right? But the point is
Mm.
like you do get to a point where the alternatives are good enough from a treatment
I
standpoint,
see.
okay?
I see. Yeah.
And then, here's the other thing. Like 70% of malocclusion cases, so, when I say malocclusion, I just mean like, crooked teeth, right? Those are for teenagers, and the problem with teenagers, um, and the reason why the market continues to be dominated by wires and brackets is compliance. It's really tough to get a teenager to keep these removable plastic trays in their on their teeth most of the day, right? So
Mm.
parents just
Mm.
tend to opt for wires and brackets to fix that to resolve that problem, right?
I
Now,
see.
Align has made some progress here. So like their percent of case volumes for teens has gone from 25% in 2017 up to 36% today, which is a lot. But it may be that they've picked all this low hanging fruit, meaning the teen cases they've captured up to now have maybe come from better treatment efficacy, but making the same kind of gains going forward will require addressing compliance, which is just a much harder, intractable problem, right?
Mm.
So then, if you can't get these teens due to compliance reasons, well, guess what? Your addressable market is just a lot smaller than you thought. And when the pie is smaller, everyone just starts to compete on price to
Yep.
stake their
Yep.
claims, right?
For sure.
Um, and so, oh yeah, okay. Now to your question about Angel's profitability here. Okay, so Angel Align is selling aligners to doctors for $850 a case, as we talked about in the US, compared to about
Mm-hmm.
1,000 for the highest volume of Invisalign tiers. Okay, trailing 12 months, Angel did $120 million of revenue outside of China, and
Mm-hmm.
they lost about 18 million on that. Um,
Okay.
um,
You
though
mean
it's worth,
operating loss?
yes, exactly.
Okay. Okay.
But it's worth noting here, though, that in the first 6 months of this year, of 2025, the non-China revenue, more than doubled and losses narrowed. So
Mm.
what that means is they are getting, profitable track it's not just a money pit, right?
Yeah.
Like,
Yeah.
they are
No.
getting
Yeah.
profitable traction here, right?
Yeah.
And so, you know, we're still talking about relatively small numbers, right? So, like, Align did more than, 1.4 billion of aligner revenue with healthy margins, so in the same year in the Americas. So it's on much smaller numbers, but the point is that Angel
H-
is showing signs of profitable scale outside of China.
how
Um,
fast your line is growing? So you said Angels has doubled
they
this year, right?
oh
Revenue
yeah,
is
yeah,
has
no,
doubled.
I
Yeah.
mean they're no Align is barely growing.
Oh, that's not good.
That's the whole thing. So
Okay.
like this is why the stock has just utterly so if you look at
Oh my
Align's,
God.
yeah.
I'm
So
looking at the chart.
Alliance, yeah, it's not
It's
good.
not pretty. It's not pretty.
Um, in the latest quarter, their cases shipped was about flat. Okay.
Ah,
And Angel is kind of growing like a weed. So and they seem to be narrowing their losses as they grow. And so that is kind of like the issue here, right? Um, and so why are they successful in a way that these other competitors weren't? I mean, one theory I have here is that these other competitors in the market, they were part of larger um orthodontic